What happens when a family files a life insurance claim after losing someone they love and the insurance company says no? Not "we need more time." Not "we have a question." Just "no." Denied. It happens more than most people realize. And in nearly every single case, the denial traces back to language the family never read, buried inside a policy they thought was protecting them. This video is for educational purposes only and does not constitute legal or financial advice. There are 7 fine print clauses insurers count on your family never reading. We're going to go through all 7, and we're going to name the one that catches families off guard more than any other. Here's the thing most people don't understand about life insurance. Buying a policy is not the same as having coverage. Those are 2 completely different things. And the gap between them, that's where insurers live. The life insurance industry paid out roughly $90 billion in death benefits in a recent year. That sounds like a lot. But the number nobody talks about is the denial rate. Independent researchers and state insurance commissioner data suggest that somewhere between 1% and 2% of all life insurance claims are contested or denied outright. At the average American policy value of around $175,000, even a fraction of those denials wipes out families financially overnight. And here's where the design of the system matters. When you apply for a policy, you sign something called an application for insurance. That document becomes part of the contract. Every answer you gave, every question you may have misread, every health detail you forgot to mention, it's all in there, and the insurer keeps a copy. You probably don't. The National Association of Insurance Commissioners, the NAIC, sets model regulations that states adopt, but enforcement is state by state. That patchwork is exactly what insurers exploit. A clause that's unenforceable in California might hold up completely in Texas. Families don't know that. Insurers do. So let's go through all 7. These are real clauses, found in real policies, used in real denials. Clause 1, the Contestability Clause. This is the most powerful weapon an insurer has, and it's completely legal in all 50 states. Every life insurance policy includes a contestability period, typically 2 years from the date the policy is issued. During that window, if the policyholder dies, the insurer has the legal right to go back through the entire application and look for anything at all, that could be called a misrepresentation. Not fraud, not a lie, a misrepresentation. That's a much lower bar. Here's what that looks like in practice. A man applies for a policy. He lists his doctor visits accurately, but forgets to mention a single urgent care visit 3 years earlier for chest tightness. He dies 11 months into the policy. The insurer pulls his medical records, finds that urgent care visit, and calls it a material misrepresentation. Claim denied. The family had no idea that one forgotten visit could erase a $250,000 payout. And under the Contestability Clause, the insurer was within its legal rights. Now, here's what most financial advisors don't tell you. After the 2-year contestability window closes, the policy becomes incontestable for most causes of death. That's why the timing of when a policy is purchased matters enormously. Some people in this situation choose to speak with an insurance attorney specifically about contestability window timing before purchasing. Has your family ever been denied a claim? Or had a claim delayed without explanation? Drop it in the comments. I read every one. Clause 2. The Material Misrepresentation Clause. This one is related to the Contestability Clause, but it lives beyond the 2-year window in certain circumstances. If an insurer can prove that a misrepresentation was intentional, meaning it rises to the legal level of fraud, they can deny the claim even after the contestability period ends. That's the lever they use when the timeline doesn't work in their favor. What counts as a material misrepresentation? Courts have generally held that a misrepresentation is material if knowing the truth would have changed the insurer's decision to issue the policy at all, or changed the premium they charged. That's a broad standard. It means an omission about a condition that feels minor to you could be ruled material by an underwriter who never met you. The strategic reality here is this. Insurers employ medical directors whose specific job is to find the gap between what you disclosed and what your medical records show. They look at prescription drug databases, the MIB, which is the Medical Information Bureau, a shared database of coded health data that most Americans have never heard of. They look at pharmacy claims. They look at everything. And the family sitting across from a denial letter usually has no idea any of this data even exists. Clause 3. The Suicide Exclusion Clause. Almost every life insurance policy in the United States contains a suicide exclusion for the first 2 years of the policy, and sometimes longer depending on the state and the policy terms. If the insured dies by suicide within that window, the insurer typically returns only the premiums paid, not the face value of the policy. For a $400,000 policy, that might mean a family receives back $4,800. What makes this clause particularly difficult is how deaths are classified. If a medical examiner rules a death as undetermined rather than accidental or natural, the insurer may treat that ambiguity as grounds to investigate further, which can trigger the suicide exclusion. Families often find themselves in a position of having to prove a negative, that a death was not self-inflicted, while grieving. Clause 4. The Accidental Death Exclusion. Some families add an accidental death rider to a policy because it pays out a larger benefit if the death is ruled accidental. What they don't read carefully is the list of exclusions inside that rider, and that list is long. Standard accidental death riders commonly exclude deaths that occur while the insured was committing a felony, deaths involving prescription drug use above prescribed dosage, deaths involving alcohol, if the blood alcohol content exceeds a certain threshold, deaths during participation in hazardous activities, and deaths that insurers classify as resulting from illness even if an accident also occurred. Here's the angle most people miss. If someone has a heart attack at the wheel and the car then crashes, the insurer may classify the death as cardiovascular, not accidental. The crash was secondary. The benefit doesn't pay. The family expected 2.5 times the base payout. They got the base. No one explained the word accident in that rider had a legal definition that excluded exactly what happened to their family member. Clause 5. The Lapse and Reinstatement Trap. Life insurance policies lapse when premiums aren't paid. Most people know that. What most people don't know is what happens when you try to reinstate a lapsed policy. And this is the clause that functions like a reset button on the contestability clock. When a policy lapses and is reinstated, the 2-year contestability period often starts over from the reinstatement date, not from the original issue date, from reinstatement. That means a family that thought they were in the safe zone past the 2-year window suddenly isn't anymore. An automatic premium loan provision exists in some whole life policies that borrows against the cash value to keep the policy active. That sounds like a safety net. But if the cash value runs out and the policy lapses anyway, many policyholders don't even know it happened until they try to file a claim. And by then, it's too late. If the way these clauses are stacked against families has surprised you, this is exactly what this channel breaks down every week. Subscribe now, and you'll know what insurers count on you never reading before it ever matters to your family. Clause 6. The Exclusion for Illegal Activity. This one sounds reasonable on the surface. If someone dies while committing a crime, the policy doesn't pay. But the application of this clause is much broader than most people expect. Insurers have used the illegal activity exclusion to deny claims in cases involving minor traffic violations that occurred at the time of an accident. Jaywalking, expired registration. A man in a case that drew state insurance commissioner scrutiny had his family's claim delayed for over 8 months because he was jaywalking when he was struck by a car. The insurer eventually paid, but only after a formal complaint. The key legal phrase is proximate cause. Courts have generally required that the illegal activity be the proximate cause of the death, not merely coincidental. But insurers use the language to delay and investigate, and most families don't know they can file a complaint with their state's Department of Insurance. That complaint creates a record, and records change outcomes. Clause 7, and this is the one that catches families off guard more than any other. The Beneficiary Designation Clause. Not the lapse, not the contestability period, the beneficiary. Here is how it happens. A man buys a life insurance policy at 24 years old. He names his mother as the beneficiary. He gets married at 29. He has 2 children. He never updates the beneficiary. He dies at 51. His wife and children receive nothing. His mother, whom he hadn't spoken to in years, receives the full benefit. The insurer pays exactly whom the contract says to pay, and the insurer has done nothing wrong. Or, consider this version. A man names his spouse as beneficiary. They divorce. Depending on the state, a divorce may or may not automatically revoke a beneficiary designation. In some states, federal law under ERISA supersedes state law for employer-sponsored policies. In those cases, the former spouse may still collect, even if a new will or court order says otherwise. This is not a hypothetical. Federal courts have ruled on cases exactly like this repeatedly. The beneficiary clause catches families because it requires no lapse, no misrepresentation, no excluded activity. It just requires that a form never got updated, and the insurer doesn't have to tell the family who the beneficiary is. They just pay it. Some people in this situation, specifically those handling an estate, consult a probate or estate attorney who can sometimes challenge a beneficiary designation on grounds of undue influence or incapacity at the time of signing. But that's a legal fight, and it's expensive. Now here's the angle that most explainers on this topic miss entirely. These 7 clauses don't operate in isolation. They're designed to be layered. An insurer doesn't need all 7 to fire at once. They need one, but they investigate for all 7 simultaneously. While a family waits for a denial reason, the insurer is running checks on contestability, material misrepresentation, and the suicide exclusion at the same time, looking for whichever ground is strongest. This is the core mechanism most families never understand. The denial letter arrives with one stated reason, but the investigation was looking for 7. The one they found and used may not even be the most technically valid, just the easiest to defend. And most families accept the first denial letter without pushing back. That's what the system counts on. Here's what the data suggests. A meaningful number of initial denials are overturned on appeal or complaint. State insurance departments maintain appeals processes. The NAIC provides a consumer complaint portal. Many states have an insurance ombudsman. None of this gets mentioned in the denial letter. The practical moves that some people in this situation take. First, request the complete claims file in writing. You're entitled to it. Second, file a complaint with the State Department of Insurance immediately, because it creates a time-stamped record. And third, consult an insurance bad faith attorney, many of whom work on contingency for life insurance denials. And about that beneficiary situation specifically, reviewing and updating beneficiary designations every 3 to 5 years, or after any major life event, is the single action that costs nothing and prevents the most common and most preventable outcome on this entire list. Here's what to take from all of this. 7 clauses, each one legal, each one disclosed, in some form, inside the policy document most families never read. And the one that causes the most grief isn't even about the death. It's about a form that never got updated. The system isn't broken. It's designed this way. Policies are written by lawyers whose job is to protect the insurer. The application is designed to create maximum disclosure obligation on you. The investigation process is designed to find any gap between what you said and what exists in a database somewhere. Knowing this doesn't make you paranoid. It makes you prepared. We just covered how insurers deny claims. The next video, already on this channel, breaks down how insurers lowball settlement offers on property claims, specifically the tactic they use in the first 30 days that most homeowners agree to, without realizing they've waived their right to reopen the claim. That one is already up. And one last thing, which of these 7 clauses did you not know about before today? Tell me in the comments, because the answer tells us exactly what to cover next.